Good morning, everybody. So today we have Mr. Vivek Choksey with us. Vivek is the Zonal Head at Emkay Wealth and he handles Mumbai, Ahmedabad and Dubai region. Hi Vivek.
Hi Kirti, good morning.
Good morning. Firstly, wanted to thank you for taking time out for this interview. So Vivek, wanting to start with a very basic question that how do you see Indian economy shaping up at large? And what impact do you see and assess globally when it comes to India as an economy?
So right now if you see Indian markets per se, there are tailwinds and there are headwinds.
True.
I will talk about the tailwinds first.
Fair.
I think if you see our GDP, we are still growing at 6.8%.
Yeah.
And if you see our inflation, it's well under control at 2%.
Yeah.
And if you see the interest rate scenario, I think the cost of money is going down. I think our central bank has kind of pressed the button to reduce rates. However, they are observing.
Yeah.
Demographically, we always, long-term India as a growth story is always intact. So I would say that, these factors are very positive.
Yeah.
For our markets and the economy at large. Headwinds are there because geopolitical scenarios, I think there are conflicts in a lot of regions, which is currently going on. And add to that, we have a tariff war going on.
Yeah.
So those are dynamics that we will, as an economy, need to navigate. I feel the current regime is doing its best in terms of navigating those challenges. So I think overall, if you see, India as an economy at large and the markets at large are looking good on a long-term basis.
Got it. Coming to equities, so over the past 1 year, we have seen the volatility in the markets. Nifty has hardly gained like 1.5%. So how do you see Indian equities perform in the near term and over the future period? How do you see?
So, currently if you see right now, there is a lot of time correction that has happened.
Yeah.
Last 1 year, if you see the indices, Nifty in itself has stayed flat.
Correct. And
that in itself indicates that there is time correction.
Yeah.
In markets, what happens if there is an actual correction or there is time correction? Now, why time correction? Because if you see domestically, our inflows are still intact.
Yeah.
And our SIP figures are close to 28,000 crores. Now, this is a very good number. This gives you that impetus, this gives you that basic support when there is selling. So, FIs have been selling. I think this year they have sold close to 1.5 lakh to 2 lakh crores, give or take. And DIs, if you observe that, they have kind of bought around 3 lakh to 5 lakh crores. So, there is that much of cushion that is there, which is kind of navigating the selling that has happened on the FI side. But in terms of the ownership also, if you see on the listed side, FIs used to be close to 20-22% and retail and DIIs used to be 13-14%. I would say DIIs specifically 13-14%. And now if you see the ownership structure of the listed space, 17% is owned by FIs and 17% is owned by DIIs. So we are kind of matching them. So, that in itself, so I would say that the first aspect in the economy is doing good. Markets are flat. That's fair. But at the end of the day, I think we should have a bifocal view. Short term, there are challenges, but over long term, I think we should do well and we should come back.
Yeah, so coming to my next question, considering current valuations and the entire perception that Indian economy is an expensive economy and that is probably also resisting the FII flows into India and they moving to China, what would be your take in the markets and what would you feel like, is this a good opportunity for the investors to, enter the market? What is your take?
See, my principle has always been that time in the market is more important than timing the market. Timing has its own positives as well. I'm not debating that. But time in the market over long term, and since the market, if you have been tracking the market since the 80s, if the compounding had happened is always long term. So I honestly feel that, time in the market is much more relevant than timing the market. So, investors per se, and even Indian markets will stay expensive. See, we are a growing economy and we will not have maybe fair or cheap valuations. We will always be high in terms of valuations. So I think if you see valuation per se, I think our PE on large cap must be 22 odd.
Correct.
And currently also we are at that level. Mid cap, if you see, I think 33 is the PE.
Yeah.
Small cap is 30. But if you see the earnings growth, you will decipher that, the large cap is growing in single digits, maybe 5 to 7% in terms of earnings. Mid cap is growing the most, 12 to 15%. And small cap is, I think, 8 to 10%. So there is a lot of opportunities across the spectrum kind, I think investors should kind of look at.
Understood. Okay. So considering equity that we have spoken on, I would like to move to, debt markets and know your views on that. So we have had our Fed rate cut happen very recently. We have also seen the India's 10-year bond yields easing since late September. How do you view debt market at this stage as an asset class, and how do you recommend the positioning of it?
See, debt is always been one of the highest allocation in largely in India in terms of overall portfolios. Now debt can be played in two ways. One is plain vanilla FDs. The second is obviously the bonds part. Now there where I think all wealth management firms and all the bond avenues in terms of as an asset class, it is quite dynamic compared to our plain vanilla FDs. So if you see the current market scenario, our GSEC yield right now is around 6.5%. We were at around 7.2, 7.3%, and we as an Emkay Wealth, we gave a call that, the yield should kind of come down and we should play duration. Duration means buy the longer end of the curve.
Correct.
And that is where I think our call went right. The yields came down to around 6.2, give or take, and I think the investors had a good rally in that. They made double-digit returns in plain vanilla GSEC funds, which is basically holding your government papers as an underline. So I think they are kind of made good returns in that. Now current scenario, if you see there is a lot of supply of government bonds that is going to happen in the coming time. I think 6 to 7 lakh crores of government supply is happening. Obviously government is doing its bit in terms of spending. When the economy is facing some kind of headwinds, government does its bit in terms of spending in the economy and give that impetus required. So they are borrowing. So 7 lakh crores is what we are expecting this financial year in terms of the supply coming in. So we see the yields at these levels, maybe at 6.5%, it will be range bound. So the expectation now should be that, we should kind of look at, from a portfolio standpoint, we should look at accruals more. And if you have, say, 100 rupees to deploy, 70 to 80 rupees should go in accruals and the remaining should go in liquid and short-term funds. There is another avenue within debt as an asset class is the credit funds, which are Cat 2 AIFs. Those give very good return in terms of accruals, because they are basically objectively driven credit that kind of companies are taking, and these AMCs are kind of giving them as well. So how they are poised is they kind of give you 16 to 18% returns, and they are in terms of their objective also is, if a company requires short-term funds for their capital expansion, for mergers, acquisition, promoter consolidation, so therein lies an opportunity as well. So it depends on investor to investor, but this could be kind of looked at from an overall investment perspective, and you can have allocation to credit funds as well. However, they have their own lock-ins because the gestation is around 6 years. But whereas the credit funds and all, they don't have any lock-in as such. The return expectations are slightly higher. So you could have some 5-10% allocation over there as well.
Understood. So continuing the same conversation, given the contrasting performance across asset classes, be it equities largely being flat, bond yields adjusting, precious metals have rallied, gold and silver. So in an overall portfolio allocation, what do you think you would position the alternatives as? What would be your portfolio allocation alongside equity and debt?
So see, equity and debt, obviously they form the larger part of the allocation, but we should not forget gold. We should not forget precious metals. I think Indian as an economy are hoarders of gold. And you will find gold in each and every household. So I think that in itself is making India rich today, right? Gold has moved up unprecedentedly. So gold and silver going ahead, honestly, I feel they might just rationalize in terms of returns because they have given CAGRs of maybe 15%, 16%. But in the longer term, I feel gold still will do well. Two factors. One is in earlier gold used to have only one use, that is a hedge against inflation. And maybe geopolitical market scenarios. So basically hedge was the main principle. Now what has happened is a lot of de-dollarization is happening. You see central banks across are buying gold as an asset class. So that in itself gives that much of demand. Because central banks buying is they have huge liquidity. So that in itself will have gold go up. Rationalization might happen in terms of returns, but I think both gold and coming back to silver also, I think silver has its own industrial use as well. And it is used in semiconductors, solar panels, mobile phones. Apart from their use, I think some money is chasing silver as well, because classically gold and silver as an asset class, there used to be a gold and silver ratio, which I think gold used to be, so it used to be 0.6, gold used to be 0.6 of silver in terms of pricing. But now because of gold's run up, I think they have now between 0.85 to 9. So that in itself has given that much of demand in silver as well. Silver will have largely industrial demand more than investment demand, but both will kind of rationalize in terms of returns as well. So I think you should have 5 to 10% in the overall allocation of a client's portfolio, 10% across depending on the risk profile, risk appetite. I would say between 5 to 15% is what you can kind of have exposure in these metals.
Understood. Okay, and one more thing that I wanted to ask was that many investors already have allocations in listed equities and mutual funds. What newer avenues should you consider, considering to diversify risk as well as earn higher returns? What would be the newer avenues when it comes to wealth as a space?
So I will slightly elaborate this answer. So see, allocation, portfolio allocation, and that is what our primary job as private banker and wealth management firm is. That has to be looked at from a holistic perspective. Now, every investor and every client has a risk profile, and they have their return objectives as well. So we have to be cognizant of that fact. So depending on the kind of risk profile that an investor has, see, equity will come in the highest risk and highest return category. Now, wealth management industry, to your question, has become very dynamic. So within equity, if I cover, I think the least risk would be around, say, large cap, because they are compounding, they have their liquidity chasing them, and they are the larger companies of the economy at large. So that would be the allocation on the equity side. So say if there is a balanced investor, then I would kind of have 50 to 60% in large cap, balance in mid cap, and some in small cap. Now there's an interesting, to your question, there's an interesting asset avenue which is opened up in this asset class, which is unlisted. Now unlisted comes in the highest return and the highest risk category. Okay, so to have that appetite, you need to be very careful. However, NSE has done very well for all the investors, and we have seen that returns. So NSE still stays a very safe bet in terms of investing. Because if you see, I think they are rationalizing in terms of their price as well. So I think NSE looks good. Then there are structured notes and all. So it all depends in terms of avenues, because the market has kind of grown dynamically in terms of different asset classes. Within that, as I said, there are credit funds which can be looked at. Which is slightly newer avenue. Silver and gold have kind of come up. Global equities has kind of come up. If you see, a lot of liquidity is chasing US markets. A lot of liquidity is chasing China markets. So I think that in itself, this has to be very dynamically managed, and you have to look at from an investor's interest and the risk profile to kind of, fit that into the overall portfolio.
Yeah, fair enough. All right. Yeah, I would really want to thank you for your insights, and we look forward to many more conversations with you, Vivek.
Same here. Always a pleasure talking to you, Katie.
Yes.
Thanks, you.
Thank you.
Thank you.